Today we are going to discuss about mutual funds. I know you might have seen the videos before itself in many platforms, but guys, today we are just not going to discuss mutual funds in theoretical way. We are going to combine the mutual funds with a practical way as well, with a practical uh, I will be giving you some practical tips where you can combine the theoretical knowledge with the practical things. Why mutual fund is important, guys? Because it is the most safest in equity. It is one of the most safest tool where we can park our money. And before we park our money, we need to understand few things which are very important before we are investing in a mutual fund. It's not that simple because what people do before investing in mutual fund, they directly go to a broker or a person who charges some commission and who is a distributor, and they advise the people and then they invest it instead of doing their own research. So today we are going to start a mutual fund, and it will be a series again where we will be discussing few theoretical concepts with practicals so that you after this series you will be well versed and you will be quite aware where to invest and how to invest in the mutual funds. Maximum concepts will be cleared practically itself. All right. So today we are going to discuss what do you mean by mutual fund, how it works, what is an AMC, what is net asset value, NAV, what are units, what is AUM, what is exit load, what is expense ratio. So guys, these terms, many of you must be aware. If you are not aware, then you should be asking question why we are discussing this, we need to learn this thing. So we need to learn this thing. So let's see practically. First of all, why we need to learn this thing. So guys, I will be sharing few websites with you as well. So it's not an advertisement. I will be sharing few websites which you can use for the research. So I will be sharing two or three websites with you. So the first website is advisorkhoj.com. You don't have to log in over here, just use it for the research part itself. So tomorrow I will be giving you one more website for this. Now, guys, let's see how and what is a mutual fund and why we need to discuss all those things before we invest in a mutual fund. See, I want to tell you, see, guys, these are types of mutual funds. All these are the types. Just imagine there is so much variety, insane amount of variety. Debt, equity, hybrid, so many things, which we are going to discuss again. Now, similarly, there are further types. And if I see, if I see here, so for example, let's take any mutual fund over here, or let's click on equity mutual fund, right? So if I click on equity mutual fund, guys, equity large, let's click over here. So you can see over here, there is a launch date, there is AUM, there is TER. These are few terms which we need to understand. And further, if I click in any of these things, right, for example, I click on Nippon India large cap. So it means, this term itself means, there are hidden definitions which we need to understand before we proceed further. So for example, Nippon India large cap, direct growth bonus. What does it means? Nippon India is the name. Large cap, what is the meaning of that? Direct, what is the meaning of that? And under this, we are discussing about AUM, we are discussing about NAV, what exactly these things are. We need to understand the definitions. Now, if I get into this, there is a term called NAV. So what exactly it means, right? So investments, total assets, turnover ratio, exit load, TER, benchmark, what exactly these terms are, guys? Because it seems, we just directly park our money in mutual funds without understanding what exactly these terms are. So we are going to understand all these things. Means what is the meaning of direct plan, bonus option, investments, total assets, what is the churning ratio, what is the meaning of that? We are going to discuss all these things. And that is why it is very important for us to understand these definitions first. So I'm not going to bore you by just giving you definitions. We are going to see practically how these definitions would be relevant over here and how we can apply these definitions while we are purchasing a mutual fund or while we are investing in a mutual fund. I hope this is clear to everybody. All right, guys, let's begin the topic, mutual fund. So, at the name itself is suggesting it is something mutual, means many people are involved. right? So before I straight away jump into definition, let's see diagrammatically what does it means. So guys, these are investors. These are people like you, me, we are giving our money to a person who is having knowledge, who is having time, and who is having good experience in handling the funds, in handling the money of people. So what happened? What happened over here? Let's take example of this class only. I will be again and again, taking the example of this class. So me, I'm a trainer. You are 30 students, for example. So 30 students, all you have money, but you don't have the knowledge. You are still learning, right? But you have the money and you need to invest the money somewhere, right? So what you will do, you have some faith on me, means you at least you have some faith that your teacher, your trainer is having at least some better knowledge, better understanding of investments, more than you at least. So what you will do, you will pool the money, you will collect the money, and you will give that money to me. So now if you give 1,000 rupee each, all of you collected 1,000 rupee each, and you gave it to me, and I collected the money. Now, on your behalf, I will be investing that money somewhere. So I will be taking the money. I took 30,000. You are 30 people, 1,000 each. And now I am having 30,000 rupee and I will be investing that rupees, those, collected amounts somewhere. So this is how a mutual fund works. And after some times, when I will generate good amount of profit with myself, means if I made, if I would have made 40,000 out of that 30,000, I will distribute that profit amongst you. Means I will distribute that profit. I will divide it by 30 number of people, and I will distribute amongst you, and I will keep some share of that profit for myself as well, because it's not a charity, right? So I'm putting my efforts, I'm putting my knowledge, my expertise, I'm investing my time over here, right? So I will be taking some commission, I will be taking some profits, I will be taking some, expenses which I have to bear. I need some internet, I need a AC, I need so many facilities to do the research, right? So I will deduct that money, and after deducting the money, I will share the profit with you, right? So this is how generally a mutual fund works, right? So mutual fund, in this pool of, investors come, they pool the money and they give the money to the fund manager. Fund manager is a person who is having good knowledge, expertise, and for last so many years he is into this. To become a fund manager, it's a very, very lucrative job. They earn a lot of money, guys. Now, let's see the definition first, then I'll give you one advice, practical advice as well. A mutual fund is a financial vehicle that pools the money from multiple investors to invest. For example, I took money from all of you and then I invest that money in diversified portfolio. Diversified portfolio means I can invest that money anywhere around. Equity, debt, combined equity and debt, real estate, gold, commodities, it could be silver, it could be anything, guys. So this is how I am using your funds and I am investing that fund into multiple, in multiple ways and multiple places. So this is how mutual fund is very important and very good way of investing. It is managed by professional fund manager. And this fund manager is not working alone. He will be working with team of people who are again expert in the same thing. Now, the question you should be asking from you, first of all, why you should invest in a mutual fund then? Why not directly in equity? Guys, if I ask you a question, you all are students, right? So to buy one share of Reliance, it will today, you need at least 2000, more than 2000 rupee right now, presently, right? But if I tell you to invest in mutual fund, you can start it from 100 rupee itself. Just 100 rupee. Just imagine. From 100 rupee, you can start your investments. Guys, it's very important once, when we are studying investment banking, it's very important. We should start as early as possible. It's in this class, nothing should be, whatever I will be teaching, nothing should be taken as investment advice. Whatever we are going to discuss, it will be only for educational purposes. No, guys, over here, see, minimum investment 5,000, 1,000. There are different mutual funds who have different minimum top-ups. So you can start as minimum amount as 100 rupee per month, 500 rupee per month. So just guys, it is such a small amount which you can invest. Now, one more example I could give you. That's there is another type of, again, a collection of money that is rich, that is a real estate investment trust. It is again just like mutual funds. So you, in at this age, guys, you can't invest in real estate, right? You're very young, but you can invest in REITs at just 100 rupee, 500 rupee per month, SIP. So you should start as early as possible. This is the first and the best benefit is that it could you can invest in mutual fund with just 100 rupee. And one more question that you should be asking, you can invest in top 50 companies of India in index fund that we are going to discuss by just 100 rupee, 500 rupee. Otherwise, if you want to invest in top 50 companies, at least you need 1 lakh or 2 lakh. But in mutual fund, buy a mutual fund, you can start your investment just from 100 rupee per month, minimum 100 rupee. If you have more money, it's fine. And if you can do lump sum, that's again, it's good. Secondly, guys, if you don't have the knowledge, instead of wasting your money, you can invest in mutual fund. Because over here, a person who is a fund manager, he invests your money. So he is having good knowledge. So guys, that is why mutual fund is a good way and good option to start your investments as early as possible in your life, right? And it depends how long you stay in the market. So even if you invest 500 rupee per month, right? So in next 20, 25 or 30 years, at least guys, you will be making good amount of money. Good amount of money. 500 rupee is just nothing as such if I tell you. Now, let's proceed further. How mutual funds work again. So guys, over here, it's just one person. It seems like it's one person, fund manager. It's not like that. Practically how it works, it is a AMC. So what happens, guys? Why would you give your money to me, being a trainer, right? You are 30 students in my class, just for an example. You collected your money and gave your money to me. Why you gave your money to me? First, you have the trust. Second, you know that this person is having expertise in mutual funds. Whatever he will be doing, he would be doing at his best, right? Same case. So it's not one person. It's just like that. I will be having team of people who will be working under me, who will be doing the research, right? So to do the research, I need people, I need resources, I need, so many things. So what happens? I will establish a company. I will start a company. That company would be called, which I will be calling this company asset management company. So I will start a company where people will be employed and they will be doing full-time job of research. So what does this asset management company do? Oh, you can see over here. See AMCs. So if I click on this AMC, see there's so many companies. Aditya Birla Capital, Axis Mutual Fund, Asset Management, Bajaj, Bandhan Mutual Fund. The which one? Motilal Oswal, you must be aware of this. HSBC, SBI Mutual Funds. So guys, all the banks, all the financial institutes, they realized that mutual fund is a good opportunity to make profits, right? So guys, what they did, they started their mutual fund companies, AMCs, asset management companies. Now these companies, as the term itself suggests you, they are managing the assets. They are taking the money from you and they are buying the assets. So that is why they are called as asset management companies. So what generally these people do? You know, what is the role of this fund manager over here, right? So fund manager basically he buys, he makes the decision of buying and selling, investing the money, where to invest, when to exit, when to pool in the money. So that decisions are taken by the fund manager. But guys, one more thing that would come into play over here. You were the investors. You are 30 students. You gave your money to me. I'm the fund manager. What if you need your money? What if someday you came to me and you say, sir, we need our money back? So I would otherwise what would happen? I would keep involved myself, into the daily transactions only. Someday you will come, ask your money back. Some another person will come, he will deposit the money. So exiting and entry in the mutual funds, it keeps on happening on everyday basis. So for this, I have a registrar. So registrar, the main job of registrar is to do the daily transactions. First thing. Second thing, I will have a marketing team. The main job of the marketing team would be handling, would be doing all the marketing of the mutual fund. Again, one more department. One more department would be customer care that would also work in this AMC. So this AMC is handling so many things. It is doing the decision of investing the money. It is handling the daily transactions, entry and exit of you people, investors. It is also handling the marketing part. It is also handling, the trusty part, the documentation part, because you are trusting me. But there should be someone, keeping light on me, keeping a check on me. Means there should be a watchdog. So Zuno app is handling me, for example. So I have audits. They audit me. So they are keeping eye on me so that I don't misuse your money. So there is someone sitting on me as well. So that person that, I have to register myself under SEBI. So government also comes in. So that is why there are so many stakeholders that come into play over here. Now, asset management company is a company. I hope this is clear to you, who takes the money from you and who manages the money on your behalf, on your behalf. So I showed so many companies to you. I hope this is clear to you. Now, guys, asset management companies, they don't do charities. They're not working for the sake of charity. That why should I waste my time taking your money and investing your money and giving the entire profits back to you? Now, I am a company, I am an asset management company, and I am acting as a fund manager, right? So I will take the money. I have team of people who are working. I have to give them salaries. I have to give them stationery, administration expenses, ACs running, electricity expenses. There's so many things which are taking place every day. Daily transactions are taking place, audits are taking place, taxation. I have to manage the taxation part as well. So there will be some expenses, and who will bear those expenses? You people. So this is a drawback in mutual fund, that in mutual fund, you have to pay the expenses. You have to pay the expenses of my company, how I'm executing day-to-day expenses. One more thing that comes into play is AUM. This is again a very important thing, very important thing. Now let's see what exactly AUM is. Let's go back over here. So over here, guys, you can see AUM, this is mentioned over here. AUM 600 crores, 2000, 2400 crores, 1300 crores, 4000 crore, 4500 crores, 35,000 crores. Just imagine, guys, how huge this number is. 35,000 crore, 14,000 crore, 1700 crores. So this is the money which this mutual fund have collected from the investors. Let me repeat myself again. So you were 30 people, 30 students. All of you collected 1,000 each and you gave that money to me. Now I have that 30,000 rupee. Now this collected money is the AUM, asset under management. What are the assets I'm managing? So first asset is the cash which I took from you, which you pooled and gave it to me. So that is the money I am holding right now. So that is AUM. Now this is, it could be huge. So these mutual funds, they had collected this amount of money from the entire country. I always give this example that even if you manage to take 1 rupee from all the citizens of this country, we are 150 crore people. So you will be sitting in the corpus of 150 crore. 1 rupee is not that heavy on the pockets itself. Same the mutual fund also do. These mutual funds are sitting at the rate of 735,000 crore rupee. Just imagine so much funds they have. They can really hit stock market in a big way because money supply is in their hands, right? Now I have taken the money from you, 30,000. Now I am investing that money. I could be buying real estate. I could be buying not real estate exactly, but I would be, investing in REITs in my behalf, or I would be investing in real estate. I would be investing in equity. In equity itself, I could be investing in big companies, medium companies, or highly risky companies, small caps, right? That we are going to discuss in the coming classes. Or I would be investing in bonds. That could be corporate bonds, government securities, so many ways. I could be investing in gold, commodities. So, guys, what is happening? The money which I took from you, I'm investing that money somewhere. So, that is also my asset. Those are my assets. I took the money and I invested that money somewhere. So, this AUM is a dynamic number. It keeps changing. It means As my assets would be performing, it will keep changing. How? You gave 30,000 to me. For example, just for an example, I invested that money in stocks. And tomorrow the stock market crashed, or there is a dip in the stock market. The AUM will decrease. Or after some days, the stock market goes up. So my AUM will also go up. So it is what AUM exactly tells how much money I am holding at that point of time, how much assets I am holding at that point of time, how much trust people are having on me. Means what I want to say, higher the AUM. Guys, this is something we are going to use in practicals as well afterwards. Huh? This is very important. Higher the AUM, better the mutual fund is. It means people are having higher trust. So what observations I can take out of this, out of AUM, is that if the AUM is higher, number one observation, that people invest a lot of money in me. They have huge trust on me. So people are investing a lot of money in my AMC. Second, the money which I had received from the people, I had utilized that money in good assets, in equity, bonds, it could be anything, but that those are performing well. So higher the AUM, it is better for a company, for investment. So one rule criteria for investments in mutual fund, that you should be seeing that AUM should be higher. Now coming back to this, so AUM is a dynamic value, guys. It changes. How it changes? Now let's see how it changes. Number one, you were 30 people, you gave 1,000 each to me, right? Now what would happen with time, that many of you out of 30, maybe five people, six students, they would love to withdraw the money. So I will have to repay the money back. So my assets will decrease now from 30,000, which I had collected from you, 5,000 you withdraw. Five of you withdraw your money. So now I am having 25,000 rupee in my hand. Many of you would be coming again, sir, I need to invest more money. So they will be giving some more money to me. So some inflows and some outflows will also takes place on the regular basis. Means some new investors will come, some old investors will take the money back. So that these transactions keeps on going on day-to-day basis. So AUM, first of all, it's a dynamic number. Secondly, the money which I had pooled from you, I had invested it somewhere. So my assets value will also increase and decrease with time. Sometimes equity market, share market, stock market will be high. Sometimes it will be low. Sometimes the debts, the gold, the other underlying securities which I had invested your money, they're performing very good, sometimes not. So the AUM will keep changing basically. So the thing is that what I want to say now, let's compile this thing. Asset under management, it is how much assets being a company, being AMC, I am handling. It could be investors' cash, it could be the securities where I had invested the money. So how much assets I am handling. Higher the AUM, it is better. Thirdly, AUM is a dynamic number, it keeps changing, but we have to see in when we are comparing it with other mutual funds. Higher the AUM, you can consider it as a good mutual fund. Now, one more thing that would come into play. If the AUM is higher, so it means I will be investing so much amount of money. Now to invest that insane amount of money, that huge corpus, I need more number of people. So let's see, if this company is handling 600 crores and this company is handling 35,000 crores. To invest this 35,000 crores, we need to do a lot of research, day-to-day basis research. And to manage 600 crores is quite easy. Now let's take an example. Mr. A and Mr. B. Mr. A is having only 5,000 rupee. Mr. B is having 1 crore rupee. Mr. B has to think a lot where to invest that 1 crore. Whereas Mr. A is not having the opportunity. Means he only have 5,000, where he what options he can explore. So the thing is that higher this AUM, the expenses also increases. One more thing is that the expenses are calculated on AUM. Guys, very, very important. Very important. Let's see. This TER, this is expense ratio. It is given in percentage, if you can see. Now, you can see it is 0.65, 0.82, 0.75, 1 point something like this. It is how the percentage is given. But percentage of what? So this is percentage of AUM, guys. So this 0.65% is 0.65% of 600 crores. 0.82 is of this. 0.75% is percentage of this. So this is how this is the expense ratio of these. Means these are the expenses of these mutual funds. Now let me reiterate myself. The expenses of HSBC Large Cap Growth Direct Plan is 1.2% of 1900 crores. Means this amount that would come, that is their expenses. And this 0.66 is of 35,000 crores. 0.75 is of this. So higher the expense ratios, guys, we are going to discuss in just next slides, but higher the expense ratios, it can impact your returns. But sometimes these are good as well because higher the expense ratio means the company is doing more research. Companies having more expenses means more people are working, so they are doing better research. So we are going to discuss this. There are some contradictory things over here, but I hope till now AUM concept is clear. It is dynamic, and higher the value, better it is. And expense ratios are calculated on AUMs. All right. Now coming to the next slide, it is net asset value. Now, guys, again, this is very, very important. Now let's click on some this one only. Nippon India Large Cap Direct Plan. So over here, NAV is 95 rupees. NAV is 95. What does it mean? As per of 20th 12th 2024. So without discussing anything yet, so there is something in NAV. It means it changes with date. It is calculated on specific dates. And with date means it is also a dynamic number. And there is an arrow minus 0.59 rupee downfall, or it is 1.6% downfall. So it means it is again dynamic number. Seeing this thing, the value is quite less, means as compared to AUM, it's quite less, 95 rupee, just rupee, all right. And something dates are also linked with this. Now let's see what exactly it is and how important it is in mutual fund investments. So guys, again, very, very important concept. Let's relate it with the example of equity, right? So Mr. Ashok, he is buying Reliance shares, right? So let's take the cost of Reliance share is 2000 rupee. So he invested 10,000 rupee in Reliance shares. So he received 5 Reliance shares. He can count how many shares he purchased? 5 at the price of 2000. So one share costed 2000. Same case, guys, in mutual funds. Whenever you are investing, mutual funds gives you units. Units, 3 units, and each unit is costing something. Now, let's reiterate myself. Similarly, as stock market, buying shares in stock market, in mutual funds, whenever you invest your money, in return, mutual fund gives you some units, and that unit costs something. Now, this is very important concept, so I want to give you a story for this. So these are 4 people: Mr. A, Mr. B, Miss C, and Miss D. Right? 4 are friends. They collected 10 rupee each to buy a chocolate box. The cost of this chocolate box was 40 rupee. So they collected 10 rupee each. So they collected total 40 rupee. So this total is AUM, asset under management. I hope this is clear to everyone. Now they purchased it and they divided these chocolates amongst themselves. So this box was having 12 chocolates and the cost of this box was 40 rupee. So each one of them got 3 chocolates. So these 3 are units. So they will receive 3 units of chocolates. I hope this is also clear. So guys, 3 chocolates, and it means they invested 10 rupee each. I hope this is also clear. So it means if I divide 10 by 3, that will be my NAV. Means that will be cost of one chocolate for me. I hope this is clear to everybody. Now let me repeat myself again. Whenever we invest in mutual funds, we get some units, and those units have some specific price. Now, let's see practically over here. Over here, it means 1 unit of this mutual fund will cost me 95 rupee. Means if I invest 95 rupee today, I will be getting 1 unit of this mutual fund, just like a share. Means the way at I buy, if Reliance is costing 2000 rupee per share, if I invest 10,000, I will get 5 units. Similarly, if I invest the money over here, these are the number of units I will be getting at this price. So this is the price of 1 unit. It is net asset value. Net means what is the value of one single asset, 1 unit of this mutual fund. So all the mutual funds will have different NAVs. Every mutual fund can cost you differently. So over here in 200 rupee, you will get 2 point something units. So there was date. Date was because stock market changes very, when you buy Reliance shares, it changes every second. Today, right now, Reliance share could be costing some another, something. After 5 seconds, it will cost you something. After 2 hours, it will cost you something because it's live. But NAVs are not live. Very important concept, guys. It is not live. It is calculated on either day-to-day basis, means at the end of the day. But generally, if I say NAVs are calculated by the end of the day, so it's not live, firstly. And since it is going up and going down, so it means NAV's value of this unit will also sometimes go up, sometimes goes down, right? So this is NAV, what exactly it is. And this is how you will get unit of, how many units you will be getting. This is something we call NAV. Now let's see unit of some another mutual fund. This time let's open HSBC, large cap. So let's click over here. So over here, 1 unit is costing 519 rupee. So it is a bit higher. So guys, this is what I was telling you. So the thing is that the NAVs can change. These are dynamic numbers. And see, the thing is that one question that should be coming in your mind now. Sir, in stock market, it is always advisable that you should be investing when the prices of stocks are at their lowest, right? Only then you can make profits. If you're buying stocks at the peak, the profit margins will go down. Very simple. The same happens in shops, same happens in commodity market, or in all the businesses. We buy at lower price and we sell at higher price. This is how we make profits. So is same concept applicable in mutual funds? So if I say yes, the same concept is applicable over here as well. If I buy NAV at the lowest, means for example, if someone had purchased or invested in mutual funds during the COVID crisis, market was at the lowest, right? They had made good profits. Why? Because the NAV's values were low. One thing that you have to keep in mind, guys, NAV values are not live. You have to wait for the end of the day. So that's why date is given over here. You have to see after how many days this NAVs are changing. So it changed yesterday. So it is day-to-day basis, 20th, 12th, 2024. I hope this is clear. Today is 21st, right? So the thing is that you have to wait. So if right now, today NAV is 519 and today evening market crashed, so you should invest tomorrow because NAV will be calculated towards the end of the day. So if you again ask me the question, sir, when the NAVs are lowest, you should invest at that point of time? Absolutely. Because if this NAV goes to 100 rupee, you will be getting more number of units. And if this NAV is higher, you will be getting less number of units. It's just the same as, let's take the example of MRF tire. The cost of one share of MRF is 1 lakh, around 1 lakh. So you will be getting only one share. The cost of uh, you can say Reliance is around 2000. So you will be getting more number of units. Same case happens in mutual funds. You should be buying during the dips, or you should be buying more number of units. But on an average, if you invest using SIP as well, guys, it will automatically get adjusted. So that we are going to discuss how to do the mutual fund research. Now let's conclude NAV. NAV is the per unit price of a mutual fund. Just like stock market, the value of one share or 1 unit of mutual fund. Just one unit is costing this much amount of money. Again, it is a dynamic value, guys. The performance of it depends, how the performing assets are doing. Means people are withdrawing the money, people are investing the money, inflow and outflow is also going on, how the underlying assets are performing, right? So NAV basically, if I tell you the formula, total number of assets divided by number of units. So why I'm subtracting liabilities over here? Because all the mutual funds, they are companies, guys. They have loans, they have other things which they have to take care. But even if I exclude this liability part, so it is total number of assets. It could be securities, it could be the cash which you had given to me, divided by total number of units. So this is how the NAV will be calculated. So it is not a market price, guys. Again, I'm telling you, it's not just like stocks. It's not a live price. It's not a market value. It is calculated. And guys, it's also a job. Many CAs, they are appointed for this thing. There's a team working to calculate just this one number. It's just not a random number, guys. Because every day, the total assets value will keep changing. So we have to keep this thing in our mind. And this is again a good job. Means many CAs, they go into this department only of calculating NAVs of mutual funds. Again, a very alluring job. Now, when should we invest in mutual funds? When the markets are low, when the markets are high? So answer would be when the NAVs are very low. So when the markets are going down, good point of good place to invest in the markets. But you have to see, because mutual funds are not live, NAVs are not live. They're calculated on day-to-day basis. You have to wait for calculation of NAV. That's it. You have to keep this thing in mind. Now, very important topic again, expenses. Guys, now let's see this thing in this way. Let's give you a story again. These people are investing money and these people are giving money to this fund manager. What if these people keep withdrawing their money again and again? Don't you think it will impact the decision making of this fund manager or investment banker, you can say? Means, for example, you are giving me your money today. I invested your money in Reliance shares, right? That tomorrow immediately you come and ask your money back. But don't you think I have to redeem those shares again and I have to give it back to you? And even sometimes the condition of the market is not in the favor of redemption, means maybe the share price is very high. Maybe the share price at that point of time is lowest and you demand your money back. So it will impact my decision making. It will impact my profits as well. Being fund manager, if you keep withdrawing your money, it will impact my investment decisions. To check that, to keep an eye on that, and to limit that thing, we have exit loads. Very important concept, guys. Exit load, as the word itself suggests you, it is that whenever you are investing in mutual funds, guys, there is some lock-in period. Lock-in period. You can't withdraw your mutual funds before that lock-in period. And if you are withdrawing, you have to pay some penalty for that. Let's compare it with PPF or FDs and RDs. Guys, if you are investing your money in PPF, how much percent returns you're getting? You're getting 7%, around 7% return, right? But PPFs are having lock-in period of 15 years, right? 15 years after lock-in, you will be getting 7% return. But guys, don't you think if you require money in between, can you withdraw? Very rare, exceptional chances are there that you can withdraw the money. It could be extreme disease, it could be daughter's marriage or something like that, or it could be higher education of your daughter, of your child, like that. In those cases, you can withdraw, but otherwise you can't withdraw the money. Now, what government is doing with the PPF, they are taking your money and investing that money somewhere, and government is making profits out of that. Same mutual funds, they invest the money. Now let's see exit load word over here. Exit load for unit excess 10% of the investment. 1% will be charged redemptions within 1 year. What I want to say, if you withdraw your money, how much money you have invested, they will be charging 1% if you withdraw within 1 year. It means you have to pay some money, some penalty if you withdraw your money before 1 year. So it is different for different mutual funds. Let's see for this one. Exit load levied on the units will be withdrawn prevailing time of the allotment for special load based on the. So this is based at the specific time. Means what they are saying. At that point of time, we will decide what load they will be charging. So what I want to say, to prevent people to withdraw the money, to prevent people to, for having the fluctuating mind that they comes in and automatically after 1 year they withdraw the money, to prevent that exit load are given. Exit load is the penalty when you redeem your mutual funds. So whenever you will be withdrawing your mutual fund, you have to pay some penalty. So it is advisable in mutual funds, more long duration you will stay, better profits you will make. It is not advisable at all that you invest in mutual funds for 6 months or 1 year because the returns would be too less, guys. But after 5 years, 10 years, 25, 30 years, the returns would be very, very high because of compounding. So mutual fund is not a short-term game. It should be taken as a long-term game, guys. So in long term, definitely you're going to get better returns. And one more thing I would like to add over here, even taxation rules of mutual funds, they differ for short term and long run. Means if you are investing less than 1 year, you have to pay higher taxes. If you are paying for longer duration, you have to pay lesser taxes. That is also, so that's why government is also encouraging people and mutual funds are also encouraging people not to invest for short term, go for long run. And if you are going for long run, it is easy for the fund manager to use your money in a better way, and it is easy for you as well to get better returns. I hope this is clear to everyone. So exit load is a fee or penalty charged by the mutual funds when an investor redeems or sell their units before a specific period. Means it could be 1 year, 6 months, 2 years. Sometimes there are no exit loads as well. Sometimes exit loads are higher as well. It differs company to company. It differs for different AMCs, differ for different mutual funds. I hope this is clear to everyone. But now, whenever you are going to invest your money, you will be seeing this thing. Means whenever, let's click on this one, White Oak Capital Large, right? So whenever you will be investing, so you will be seeing this thing. So over here, exit load is if redeemed within 1 month, it is 1%. So just see for different mutual fund, it is different. And NAV is also 14 rupee. It is so less. Now, guys, whenever you will be investing, we have to see these things. Let's not take investments in mutual funds so passive that you just take advice of your, commercial bank people and whatever they'll suggest you invest in that. We will be learning all these things over here, how these things work. After this session or after next 2 or 3 classes, you will be quite positive, quite confident. You know, whatever knowledge will be required for the mutual fund investment, you will be having that. I hope this is clear to everyone. So now onwards, we will be reading about exit loads as well. Now, what about entry loads? Guys, there was entry load as well, but SEBI revoked that. So we don't have to worry about that. Earlier, there were some charges for entry as well, which were charged by the mutual funds, but that is excluded by the SEBI now. Now, expenses. As I told you before, that mutual fund is a company. It's not a charity. And the main motive of any business, any company is to make profit. And how I would make profit being a asset manager. So whatever money you will be giving to me, whatever profits I will be generating from the investing your money itself. It's your money. I will take your money, invest that money. I will generate profits. I will keep some share of that profit, and I will give the profit back to you after keeping the share, and I will divide the profit amongst you. Even if mutual fund doesn't do well, I will keep some expense charges. Expense means I have people doing the research. I have teams working for me. I have different departments. So expense ratio is the cost incurred by the fund houses to manage and operate mutual funds. These are day-to-day basis expenses. It is percentage of AUM, guys. This is very important to understand. This percentage expense ratio is percentage of AUM, asset under management. Higher the AUM, so percentage will also increase a bit. High expense. See, guys, one more question I would like to ask. It's a bit contrary, though we are going to see it in practicals itself. But, guys, let me tell you one thing over here. Let's go back. AUM, this is the AUM value, right? This is total expense ratio. Sometimes, though expense ratios will be deducted from the profits from your investments only. So it will hamper your returns. Definitely. This is one thing. Second thing, people think higher TER, higher expense ratio is bad. See, sometimes it's bad because it is impacting your investments, but sometimes it's good as well. Why good? Because guys, if expense ratio is higher, it means that fund manager, that AMC is investing and doing more expenses in terms of equity research. They are doing more active research. So higher expense ratio could be better as well many a times. Means they are using your money for better research. So for this, you have to see previous, years data that we are going to see, how to do the research in the mutual funds. But we have to see whether this high expense ratio is misuse of money. Means sometimes they can misuse the money. It may not be for research, but sometimes it is for the betterment of the investments as well. For higher research, you need higher money, higher tools, more number of tools. So that is why sometimes it could be high, sometimes higher could be better, but many a times higher could be bad as well because it is impacting your investment decision as well. So, but this percentage is always of this AUM. Very, very important, guys. So this 0.66% is of 35,000 crore. 1.2% is, so the numbers would vary. So whenever you are seeing the expense ratios, yes, the concept should be like this: lower the expense ratio, better it is, because it will be charged from your investments only. Second, you have to see, what kind of fund that is. It is active fund or passive fund. We are going to discuss it in the next coming class because, guys, there are so many concepts we need to understand before investments. We just directly invest in mutual funds, but it's not that easy. But the research of IPO and mutual funds is very simple as compared to equity research. Equity research is a bit complicated. You have to follow so many steps, but in mutual fund, the steps are quite easy, guys. Because over here, you are not the one who is doing the research. It is the mutual fund manager who is doing the research on your behalf, basically. So that is why the expenses over here are quite uh, the expenses you have to bear because you don't have to use your brain. You just have to use your brain to find a good mutual fund. That's it. Your job is done. So, few practical advice to you. Again, it should not be considered as investment advice, just for educational purposes. Now, for example, you took a loan. You took a loan of 30 lakh rupee, just for an example. And on per month basis, you are paying 40,000 rupee as your EMI on that loan. One thing that you keep on paying that 40,000 rupee EMI. Second practical advice which I can give you, instead of paying 40,000 rupee EMI, pay 30,000. Increase the loan duration and use that remaining 10,000 and invest that 10,000 as a SIP in mutual fund. Again for that duration. In next 10 years, if you extend your loan for next 5, 10 years, guys, in next 10 years, your mutual fund, 10,000 rupees SIP in mutual fund give you that much amount of corpus which can be compensated in the loan. Many people, they overcome their loans by dividing some EMIs of loan by using the EMIs of loan into mutual fund SIPs. So increase the duration of loan and use that SIP, use that money instead of giving into the EMIs of the loan, use that money given for the SIP. So mutual fund on an average will give you on yearly basis, if I say around 18% return, 16, 18% return. And your loans would be around 12%. So guys, anyhow, you will stay at the profit of 6%. It is a good return. Easy brain, no issues at all. You are making the bank also happy by returning their EMIs and you are earning money from their EMI only. Just deducting bit out, some small proportionate amount of money from the EMIs only. So you will be making profit of 8,000. And and if the duration of the mutual fund is long, easily you can you can overcome the loan at very fast duration. In if I compare it, if you wouldn't have done this thing, same. If you are buying a car, guys, over here, but so we are going to discuss what is SIP, what is STP, what is SWP in the next coming classes. But I'm giving you just an example. Practical example number two. Instead of buying a car, means your car will be costing you around 10 lakh rupee, for example. Let's invest that 10 lakh rupee in SWP and take the car on loan. Use the withdrawal plan and use the money coming from SWP into giving that EMI. And by doing this, you will making profits. So again, it is very practical. You can use the mutual funds, guys, in a very wise manner. And mutual funds can also be used to overcome taxes as well. That we are going to discuss in the coming classes. That what types of mutual funds are these. So these were two practical tips which I wanted to give you. Now, guys, I hope this is clear to everyone. Today we discussed very important topics: NAV, units, AUM, expenses, and exit loads. Now, next topics we are going to come again by tomorrow, and we are going to discuss everything practically over here, guys, not theoretical.